What's up, everybody? Welcome to the December 1st, 2025 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to get right into the hot button issues that are going on in the markets this week. So let's get started. Let's start here. Black Friday. Black Friday just passed, and 4% year-over-year growth is the last number that I saw. There's a little tempered enthusiasm saying that we might see Cyber Monday have more of a crest off than we did before. But overall shows that, hey, we're still spending money to a certain extent out there. So there's not the incredible fear and panic. Again, looking at the do what I say or look at what I say versus look at what I do. Looking at what you're doing right now for the U.S. consumer, they're still at least out there spending. There's not a massive retrenchment. Generally, airports are still doing okay. Black Friday still growing year over year. We'll see. We'll see how long this continues. Certainly, consumer confidence says that this is coming to an end. If inflation continues to rise upward and accelerate upward, I don't think this can continue. But if we stabilize from there, even bring that down a little bit, there has been some tariff alleviations here and there. So hopefully maybe that'll reduce some pricing. But overall, the numbers aren't terrible right now. There does tend to be a pretty big difference between the consumer sentiment, consumer confidence data, which again is cresting at very low rates right now and very low levels compared to what's actually happening out there. Now, again, the most recent data points, and I said this a couple weeks ago, is the most recent data points from the companies wasn't so hot. You had Chipotle, Lowe's, Home Depot, a few other people bringing down earnings. The ones that were actually doing well were more of the value plays. So maybe there's a shift in spend, but just the general Black Friday numbers suggest that at least there's not a full-on turtle head retrenchment of spend. So that's a decent sign for the markets. We'll see how that goes going forward. Turning to the higher probability of a December rate cut, it has gone from a 50-50 proposition a few weeks ago to almost 90%. I think it's high 80s right now in the probability of a December rate cut. We had some commentary come out from a Fed governor that suggested that the rate cut was on the table. So the commentary has eased on, if you looked at it right after the last cut, there was a lot of discussion around, hey, don't consider December a done deal, that kind of stuff. It does seem to be waning a bit from that. And certainly the probabilities would suggest that's the case. So whether they're seeing economic data that from a jobs perspective gives them a little bit more worry to say, hey, we're still in the clear for a cut here. And on the other side, maybe inflation data, the stuff that they're coming back and seeing now that the government is open and they're getting some data again, maybe they're seeing things aren't quite as bad. And so they feel a little bit more comfortable that they can be a little more easing on that and not create an accelerated inflation profile. Whatever it may be, it sounds like it's more December, looks like it's going to happen from a rate cut perspective. Again, does 25 basis points change the world? Absolutely not. But that trend of the downward tends to be favorable for markets over time. If rates get cheaper, that means loans are cheaper. That means CapEx can be out there. And if we can reaccelerate growth as a result of that without stymieing it basically based on inflation, then that's a good thing. So a natural tailwind for the markets is, rate cuts tend to be a natural tailwind. I don't think it's as aggressive as it used to be because we're not as goods reliant. But again, with how much we're spending on CapEx and artificial intelligence, maybe we are becoming a little more goods and CapEx reliant nowadays anyway. So I think it's helpful overall. I don't think it's world changing. I don't think you're going to see a massive signal change of bullish or bearishness based upon what happens in December, unless you start to hear in the commentary that they're changing course or economic data suggests either a significant weakening of the job market or a significant acceleration of inflation, both of those being bearish. Turning to not bearish is Wall Street prediction time. So if you all follow this stuff, and many of you do, some of you don't, that's okay. We get strategists, investment strategists from Wall Street. I'll come out and say what 2026 is going to look like in their predictions. And for the most part right now, people are tending to be pretty bullish. They're pretty positive on the markets overall 2026. There's some thought that we could see some of the tax effects from the OBBBA. that could accelerate spending profiles. Some of this labor weakness and inflation could be temporary and it could readjust in 2026. And still, earnings growth, the expected earnings growth for 2026 is still in the double digits at this point right now. So there seems to be, among strategists, a lot of perceived tailwinds to the market. Our side here, what we tend to use these for is I really don't care what they're putting out from a number, from the S&P 500 target number. It really is irrelevant to me for the most part. What I want to find out is how they're getting there. Because the big one for me right now is if you're bullish, which is absolutely fine. Markets work 7 out of 10 years. So being bullish is probably the right side of the coin to be on over a longer period of time. But if you're bullish right now, you have to understand that valuation is higher, even among the average company. You know, if you take out the Mag 7 and you do kind of these crazy math that people are doing, you still are at an elevated valuation overall. So you're saying that, hey, that can stay elevated. That's fine. That's a good argument. And especially in the 12 months, it could absolutely happen. But how you justify that going forward, that's what I would like to hear from the strategists. And that's what I pay attention to. And a lot of them are saying because of the earnings, and we could re-accelerate earnings in 2026, a lot of them are saying that, that the valuation that we're paying right now, especially for these higher growth companies that make up a lot of the S&P 500, is justified. It's an argument. I understand the argument. I don't know if I necessarily agree with it, but again, from my side, you'll never hear me put a number up for the S&P 500 anyway. I think it's largely folly. I don't think that there is a lot of real science behind it. There's a lot of numbers behind it. There's not a lot of real science about it. So I think from my side is, again, what I am more interested in is outlook and positioning. That's much more what we would say from outlook is like, hey, where are we at from a valuation perspective? Where are we at? What do we expect from longer term? What do we expect from bonds? That kind of thing, just kind of setting long-term explanations and outlooks in that regard. And then setting positioning. Where would we be going overweight? Where would we be going underweight? I think that's the more important component. And strategists do some of that. It's just lost within the content of the headline of S&P 500 is going to do X this year. I don't care about that headline. Lastly, I'm going to talk about holiday movies here. And holiday movies are at the Bryan household. We do the same ones every year and we love them. Thanksgiving is Planes, Trains, and Automobiles. No question, has to be done. One of the funniest movies ever. I think head to toe. I just found out it's barely over an hour and a half long, which that's a lost art in Hollywood now, is keeping things to an hour and a half to an hour and 45, which is perfect from that because there's no fat to chew on in there. It is just pure comedy and situations that are hilarious. I love that movie. We also hit the holiday movies this year, the Christmas movies this year. We did Christmas Vacation, which we do every year. We also did Home Alone this weekend. So it was a broad swath of, on Thursday, we watched Planes, Trains, and Automobiles. And then yesterday we were watching the Christmas movies. So we're actually already done with our quote unquote mandatory holiday movies. But those three are on the pantheon for me, and I'll watch them pretty much every year. I do have a little hot take on Home Alone, though, is that the first hour is actually kind of boring. It's the last half hour that makes the ride so much more worth it. When they go into the house is what is comedy gold there. The beginning part of it, up until that point, I understand it has to set up the story, and there's some things involved, but it's not quite as good. But the last half hour more than makes up for it. So we'll probably continue to watch it every year. Christmas Vacation, solid from beginning to end. Still one of my favorite movies, even non-Christmas movie. It's still one of my favorites. I think it's hilarious. Again, another one that's sub 2 hours that just goes and goes and goes. So that's my holiday movies. If you haven't watched any of those three, I highly suggest hitting those before December 25th. That's my wrap for the week. Tune in next week. We'll have our next Hot Button Topics. Until then, thank you very much and take care.